You're a seasoned investor, armed with charts, data, and years of experience. The market dips slightly, whispers of uncertainty ripple through the news, and suddenly, your heart races. You sell everything in a frenzy, only to watch the market rebound days later, leaving you with massive losses. Sound familiar? Why do even the smartest investors crumble under pressure? Stick around, because today, we're diving deep into the psychology behind market panic and uncovering why brilliant minds still end up losing big. This isn't just theory. It's the hidden force that could be sabotaging your portfolio right now. Let's start with a real-life nightmare that shook the world. Remember the 2008 financial crisis? Wall Street titans, Ivy League graduates, and hedge fund geniuses all watched in horror as the housing bubble burst, Lehman Brothers collapsed, and panic spread like wildfire. But here's the twist. Many of these smart investors were unblindsided by bad data. They were hijacked by their own brains. The fear center, that ancient amygdala buried deep in our skulls, lit up like a Christmas tree, overriding logic and screaming run. It's the same primal instinct that saved our ancestors from saber-toothed tigers. But in the modern stock market, it turns savvy traders into impulsive sellers. Curious yet? What if I told you this isn't just about fear? It's about a cocktail of emotions and biases that even the most disciplined minds can't escape. Think about it. You've pored over earnings reports, analyzed trends, and built what you think is a bulletproof strategy. Then, a tweet from a celebrity investor or a viral Reddit post sends the market into a tailspin. Suddenly, everyone's selling, and you feel that pull, that irresistible urge to join the herd. This is herd mentality at its finest, a psychological phenomenon rooted in our evolutionary need for safety in numbers. Back in caveman days, if the tribe ran from a threat, you ran too, or you got eaten. Fast forward to today, and social media amplifies this 1,000-fold. Platforms like Twitter and TikTok turn isolated opinions into global stampedes. During the GameStop frenzy in 2021, retail investors piled in, driving the stock up 1,500% in weeks, only for many to panic sell at the peak of the hype. Smart people with MBAs and algorithms got swept up because their brains whispered, "Everyone else is doing it. You don't want to be left behind." But why does this happen to the intelligent ones? It's because intelligence doesn't immunize you against emotion. In fact, overconfidence, another sneaky bias, makes it worse. Overconfidence bias is like that friend who always thinks they're the smartest in the room. Studies from behavioral finance pioneers like Daniel Kahneman and Amos Tversky show that even experts overestimate their ability to predict markets. Kahneman, who won a Nobel for this work, explained in his book, Thinking, Fast and Slow, how our brains rely on two systems, the quick, intuitive one, and the slow, analytical one. In panic mode, the fast system takes over, leading to snap decisions. Picture this. You're watching CNBC, and the anchor declares, "This could be the next dot-com bust." Your analytical brain knows markets recover, but the intuitive one floods you with adrenaline, urging you to sell. And here's the emotional kicker: loss aversion. We hate losing twice as much as we love winning. A $1,000 loss feels like a gut punch, while a $1,000 gain is just a pat on the back. This asymmetry, proven in countless experiments, explains why investors hold on to winners too briefly and dump losers prematurely during panics. But let's make this personal. Have you ever stared at your portfolio during a downturn, feeling that knot in your stomach? That's not just anxiety. It's the psychology of regret, aversion kicking in. We dread the pain of admitting we were wrong, so we double down on bad bets or exit good ones too soon. Take the COVID-19 market crash in March 2020. The S&P 500 plummeted 34% in weeks. Smart investors, including fund managers with billions under management, sold off blue-chip stocks like Apple and Amazon at rock-bottom prices. Why? Because the uncertainty triggered a cascade of negative emotions. Fear of the unknown, amplified by 24/7 news cycles. Media headlines scream doom, markets in freefall, exploiting our negativity bias, where bad news sticks harder than good. Our brains are wired to prioritize threats, a survival trait that's disastrous in investing. Yet, those who held on or bought the dip saw massive gains as the market roared back to all-time highs by year's end. The lesson: panic isn't about the market, it's about the mind. Now, curiosity demands we explore deeper. What role does FOMO, fear of missing out, play in this chaos? FOMO is the evil twin of herd mentality, pushing us into bubbles rather than out of them. During the crypto boom of 2021, Bitcoin surged to $69,000, luring in intellectuals and analysts who knew better. They bought high, driven by stories of overnight millionaires, only to panic when the crash hit in 2022, wiping out trillions. Psychologically, FOMO activates the reward centers in our brain, releasing dopamine like a slot machine jackpot. But when the tide turns, that high crashes into despair. Smart investors fall for it because they rehuman. No amount of IQ shields you from the thrill of potential gains. And let's not forget confirmation bias, where we seek out information that confirms our fears. In a panic, you'll scroll through bearish articles, ignoring bullish signals, convincing yourself the end is near. Emotional curiosity builds as we ask, can we outsmart these traps? Absolutely, but it requires self-awareness that borders on obsession. Start with mindfulness techniques. Yes, meditation isn't just for yogis. It's a tool Warren Buffett swears by indirectly through his calm demeanor. Buffett, the Oracle of Omaha, famously said, "Be fearful when others are greedy, and greedy when others are fearful." But how does he do it? By detaching from the emotional noise. He reads annual reports in his quiet office, ignoring daily fluctuations. For you, that means setting rules, diversify to cushion blows. Use stop-loss orders sparingly to avoid knee-jerk sales, and journal your decisions to spot patterns in your panic. Imagine keeping a trading diary today. I felt fear because of X headline. Did I act rationally? This reflection interrupts the amygdala's hijack, giving your rational brain a fighting chance. Let's stir more curiosity with a hypothetical scenario that feels all too real. Suppose you're invested in tech stocks, and a geopolitical event, say, tensions in Taiwan, sparks rumors of chip shortages. The Nasdaq drops 5% in a day. Your phone buzzes with alerts. Friends are selling. Forums are ablaze with doomsday predictions. Your pulse quickens. Sweat beads on your forehead. This is the moment psychology tests you. Will you succumb to anchoring bias, fixating on the stock's recent high and seeing the dip as a catastrophe? Or will you recall historical rebounds, like after the 1987 Black Monday crash, where the market fell 22% in one day but recovered within 2 years? The smart investor who loses does so because they anchor to short-term pain, forgetting long-term trends. To combat this, educate yourself on market cycles. Booms and busts are as predictable as seasons, yet our emotions make them feel apocalyptic. Diving into the emotional depths, consider the role of stress hormones. Cortisol floods your system during panics, impairing judgment and narrowing focus. It's why pilots train in simulators to handle crises without the hormonal haze. Investors can do the same with paper trading or mental rehearsals. Visualize a crash, feel the fear, then practice calm responses. This builds resilience, turning panic into opportunity. And here, as a curiosity-sparking fact, research from the Journal of Finance shows that investors who trade less during volatile periods outperform those who react impulsively. Less is more. The tortoise beats the hare in investing because the hare panics at every shadow. But why do women and men handle this differently? Studies suggest women often exhibit less overconfidence, leading to fewer panic trades, while men might chase highs more aggressively. Regardless of gender, the key is emotional intelligence, recognizing when fear is lying to you. Think of it as a thriller movie. The suspense builds, but you know the hero survives. Markets are the same. They've survived wars, depressions, and pandemics. Yet, in the heat of the moment, that knowledge evaporates, replaced by visceral dread. To heighten your watch-time curiosity, ponder this. What if your next big loss isn't from a bad pick, but from ignoring these mental pitfalls? Shifting gears to practical antidotes, let's explore cognitive behavioral techniques adapted for investing. Challenge your thoughts. When panic hits, ask, is this fact or feeling? Fact, markets fluctuate. Feeling, this is the end. Dissect headlines. Most are sensationalized for clicks, not accuracy. Use tools like diversified ETFs to spread risk, reducing the emotional sting of any single loss. And build a support network, not echo chambers that fuel panic, but rational peers who ground you. During the 2022 bear market, when inflation fears peaked, those with accountability buddies sold less impulsively. Curiosity peaks as we uncover sunk cost fallacy. Why we cling to losing investments, pouring good money after bad, because admitting defeat hurts more than the loss itself. Smart investors fall for this, tying ego to trades. Break free by viewing each decision anew. Would you buy this stock today? If no, sell. This detachment is liberating, emotionally and financially. And don't overlook availability bias, where recent events loom larger. A fresh crash makes another seem imminent, even if stats show recoveries are the norm. To keep you hooked emotionally, let's share a story of redemption. Meet John, a fictional but relatable quant analyst. In 2018, during the trade war volatility, he panicked and sold his portfolio at a 20% loss. Devastated, he studied psychology, learning about these biases. By 2020, when COVID struck, he held firm, even buying more. Result, tripled his returns. John's tale shows transformation is possible. It's not about being smarter. It's about being wiser to your mind's tricks. As we build toward the climax, consider the power of positive visualization. Athletes do it. Why not investors? Picture navigating a panic calmly, emerging stronger. This rewires neural pathways, making composure second nature. And incorporate humor, laugh at market absurdities. Remember the 2021 Suez Canal blockage. A single ship halted global trade, spiking oil prices briefly. Panickers lost. Humorists saw the folly and stayed put. Now, layering in more curiosity. What about algorithmic trading's role? Bots don't panic. Right, wrong. They're programmed by humans, embedding our biases. Flash crashes, like in 2010 when the Dow dropped 9% in minutes, were amplified by automated cells. Even AI isn't immune if trained on panicked data. This underscores that psychology permeates everything, from individual trades to market mechanics. Emotional intensity rises as we confront greed's shadow side. Greed fuels bubbles, but panic pops them. Balance comes from contentment. Set goals, like a 7% annual return, and stick to them. Avoid the trap of comparing to others. Social media's highlight reel distorts reality, breeding envy and rash moves. To extend watch time with intrigue, tease this. Hidden in plain sight is the disposition effect. Selling winners too soon to lock in gains. Holding losers hoping for turnaround. It's emotional hedging against regret. Counter it with rebalancing rules, automating decisions to bypass feelings, wrapping the emotional journey. Remember, markets are a mirror to our psyche. Panic reveals fears. Composure builds wealth. By understanding these dynamics, you transform from victim to victor. If this unlocked secrets in your investing mind, smash that subscribe button and turn on notifications. Your next video on mastering market emotions awaits on the channel. 11.1